Ladies and gentlemen, welcome. This is Christopher Aaron. It is May 21st, 2020. This is going to be an extremely important video. We are going to look at a signal which is forecasting that a global depression is on the horizon that is going to eclipse what we have already seen over the last several months due to the coronavirus. We're going to look at the evidence for that, the signal. This will impact you whether you are investing in gold, silver, stock markets, bond markets, or currency markets. Whether you have your retirement accounts in a 401k or in a self-directed super fund in Australia, this is going to impact you. Whether you're primarily holding US dollars in cash, this is going to impact you. Whether you are accumulating silver, this is going to impact you. And for that reason, I want to encourage you to share this video with as many people as you think would benefit from it. And just on that moment, make sure to hit the big red subscribe button below the video. And for that matter, while you're down there, hit the little bell icon because that way you will get notified when future free videos come out in this way. This is a huge topic. This is going to impact us all over the next several years. This will not be an academic exercise. This will be something that actually impacts our lives. So we are talking about a signal here that has only appeared twice in the last century. That is how important this signal is. What is the signal that we are talking about? It is the gold to silver ratio. And the fact that the gold to silver ratio has just broken out not only above an 80-year resistance zone, here you can see at this 100 level, but this is actually a new all-time high, all-time in the history of record keeping, the history of mankind. And we have very good data going back to the colonial period in the United States. But we do have data even going back further, even back to biblical times. This is the highest in the gold to silver ratio that has ever been witnessed in the history of mankind. Now, if you are primarily investing in stocks and you are saying, well, who cares about the ratio of gold to silver, or you're primarily investing in oil or Bitcoin for that matter, I want to show you why this is important. First, we need to understand what we are actually looking at here, what the ramifications of this are. When we're talking about the gold to silver ratio, we are talking about gold, which is primarily a monetary asset. Gold has backed currencies for hundreds and hundreds of years, and when it does not back currencies, it competes with currencies as a reserve asset, primarily a monetary asset. Silver is a dual role asset. Silver used to serve as money back in the founding of the United States, the expansionist periods here. Silver was convertible to US dollars. It no longer is. And for that matter, at this point in time, 80% of the world's silver is consumed by industry, whereas only a fraction of the world's gold is consumed by industry. So at extreme points, when faith in currencies is lost, we do see silver begin to take on more of a monetary role. But for most of the last 80 years, silver has been primarily an industrial metal with a secondary monetary metal component. And so what we are looking at here when we're talking about the gold to silver ratio, just conceptualize this for a moment. We're talking about the value of monetary assets versus dual but primarily industrial assets. And so when we see monetary assets spiking like they are doing right now relative to industrial assets, this is showing us that something unprecedented is happening and that the world is headed for a period of massive deflation. Deflation. When we see things, components of industry losing value to money, this is the definition of deflation. Things losing value relative to monetary assets. And so this is even more important when we're seeing this on a as I said, an 80-year scale here, breaking above an 80-year resistance zone. You do not see things like this happening every single year or every single decade. It goes back 80 years. So, what are the ramifications of this? In order to understand how important this signal is, we have to go back to the year 1929. And we have to study what occurred in the 1920s and then following that in the Great Depression. That is the last time that we have seen this signal, twice in the last century. Let's take a look at it. We need a bit of a backdrop in order to understand how severe this signal is shaping up to be. Here's the Dow Jones Industrial Average from 1900 to 1929. We can see a series of booms and busts as the United States was industrializing, the founding of the Federal Reserve here making things a bit more volatile, World War I causing a mini depression here, and then an inflationary outcome after that. But all things considered, kind of a 3 steps forward, 2.5 steps back kind of trajectory here for world stocks. Until when? Until the Roaring 20s. Now, of course, the Roaring 20s were a time of great technological innovation. And so world stocks, the Dow Jones here began to price in an increase in efficiency in world stocks. We can see almost a doubling in the value of the stock market between 1924 and 1927. What were some of the things, some of the legitimate things that really began to change the world in the 1920s? We're talking about the mass adoption of electricity in urban areas. We are talking about the first commercial radio broadcasting going on in the 1920s, so mass communications expanding rapidly. What else? The invention of rockets, liquid-fueled rockets in the 1920s, and we know how that would change the scope of military power over the decades to come. So a lot going on here in the 1920s, but something happened by the late 1920s which caused the stock market to go from a simple roaring 20s kind of period to what? A speculative bubble. Anytime you see a market that's moving at a 45-degree angle higher for a number of years that then starts to take on more of a vertical move higher, that is telling you that this is developing this parabolic curve that we see so often in these manias. And parabolas tend to be the signs of speculative manias that are developing. We all know there were many people at this time speculating on stocks, buying stocks just because they were going higher, similar to what we saw in the NASDAQ bubble in the year 2000. You all know the stories of the shoe shiners giving tips to people because they were making more money speculating on stocks than in actually their vocation of shining shoes. So the speculative bubble of the 1920s developing. And what we want to do is take a look at what happened here into the final stages of this speculative bubble in 1929. Was there a sign that perhaps this was not going to be sustained, as many of the pundits at the time believed, but perhaps this was more of a crash waiting to happen? So what I want to do here is fill in for you the first year after 1929 of what happened to the stock market first. First, I want to show you the first 2 chapters after 1929. There was a 48% mini crash in late 1929. This was the first chapter. The second chapter was a 50% recovery of that 48% crash. So this brings us into the year 1930. And what I want to do here is zoom in on this 29 to 30 period. Let's bring that in here. And we can see it. There was that 48% decline. Here's that 50% retracement. We just looked at that. Now, look at this quote by President Herbert Hoover in May of 1930. This is what he said. Well, the crash only took place 6 months ago, and he's referring to this crash right here, that first little part of the crash. While the crash only took place 6 months ago, I'm convinced that we have now passed the worst and with continued unity of effort, we shall rapidly recover. There is one certainty, that is prosperity. Okay, so the President of the United States believed that the worst was over here in the beginning of 1930. Was there any evidence that perhaps he was celebrating a little bit too soon? Yes, there was, and it's called the gold to silver ratio, which did something very similar to what we are now witnessing, and it did it right here in the first quarter of the year 1930. So I want to show you that signal first, and then we'll go back to the present. We'll look at what is happening here. So here's back to the gold to silver ratio. This is 1895 to 1929. So once again, a 3.5 decade period here where we can see the ratio oscillating between this 40 figure and in the low to mid-teens here, 17 or so, excuse me. And so remember, anytime that we see this ratio spiking upward toward the 40, this was showing us deflationary forces were going on. So we're seeing, for example, the very beginning of World War I causing a deflation around the world, and then all the debt and all the money printing that had to be taken on to pay for that, causing inflation in the later stages of the war and after the war was over. So everyone up until this point in time only knew that the gold to silver ratio could only get up to 40. No one ever had previous data. The ratio had never gone above 40 ever before in the history of mankind. Up to this point. Never, not once, ever had the ratio gone above 40. So, let's fast forward 1 year. What do you think people were saying here in 1928, 1929 as this ratio was creeping back toward 40? They would have been saying, well, yeah, we're just going through another one of these periods right now, but silver is a good buy right now relative to gold. We've had a bit of a deflationary period, and soon we're going to have inflation again. That's what everyone would have been saying based on the known history of this ratio. Something strange happened when we fast forward this one more year. 1 year only. And the ratio broke up above the previous all-time high, exactly the same as we are now seeing. A new all-time high in the gold to silver ratio, smashing through all previously known resistance zones. When did this happen? The very beginning of 1930. Let's bring it back to the stock market. Remember that quote by President Hoover. The worst is behind us, he said in May 1930. Yet, at the same time, the gold to silver ratio was warning something. Who was right? The gold to silver ratio was breaking out here. Hoover saying we've passed the worst here in May. Boom. 84% collapse in the U.S. and world stock markets over the next 2 years. It wasn't just stocks that collapsed. Real estate collapsed. We have evidence that condominium prices in Manhattan fell by 60% during the first 2 years of the Great Depression. And for that matter, they then took 2 decades to recover that 60% loss. Not just stocks, not just real estate, commodities, businesses, bread lines, everything that we know about from the Great Depression in the 1930s was hinted at right here in early 1930, in spite of what the politicians were saying, in spite of what the central bankers were saying. That all-time high breakout in the gold to silver ratio is an unemotional warning, an unemotional data point showing us that industry is suffering relative to gold, relative to money. And you could say, well, gold is not money now, and technically that's true because the world uses US dollars, but gold retains its monetary history and its monetary inclination in ways that no other metals do at this point. And so, when we go back to the present and we look at this happening once again, this ratio breaking out to a new all-time high once again. Remember that from the year 1930. And here we are right now. We have just seen a mini crash similar to that first crash in 1929. We have just seen a 50% recovery. We are seeing all of the politicians out there saying, hey, maybe the worst is over. We're seeing the heads of central banks saying we have this thing under control. Most people believe them. But the gold to silver ratio is giving that exact same warning, and I would argue an even more ominous warning than it gave in 1929, 1930, because at that point we were only breaking out over a 35-year boundary. The gold to silver ratio right now is breaking out above an 80-year consolidation. If those numbers were to manifest again from this point, if we were to have an 84% collapse in the Dow Jones Industrial Average over the next 2 years, that would imply a Dow in the range of 3,000. Now, this need not play out exactly the same way that it did in 1929. In fact, I'm pretty sure it will not. There will be twists and turns along the way, some of which we will be able to get good warnings about, some of which will be true black swan events that occur as this whole thing is happening. The point is, this signal has only appeared twice in the last 100 years. There was the first time it appeared. It happened right there at the recovery in 1930, before what was an overall 90% crash. Here is the current version. The exact same thing is happening again today. So if you are heavily invested in, let's call them conventional assets, such as stocks, you cannot afford to ignore this signal. Could this signal be completely wrong? I suppose it could. Ultimately, nothing is known in the future with 100% certainty. But when we look at the comparison between how these markets look for the previous decades, that parabolic rise, the beginning of a parabolic rise here over the last number of years, that initial mini crash, and the gold to silver ratio breaking out as this recovery is happening, boy, this is the time to consider some defensive action. Some defensive action is going to be better than no defensive action. The other thing that is going to be good is to own some gold. Keyword some. It will be a different amount for every individual. But the word some, if you don't own any gold at all, on the next pullback, which I suspect is coming over the next few months, owning some gold is going to be very important for navigating this. Gold was basically the only asset class that held up in the Great Depression. And in fact, not only held up, but it gained 75% as stocks were crashing 90%. And of course, that revaluation was due to government decree at that point when Roosevelt confiscated gold and then revalued it higher by 75% overnight in 1933. We don't need the government to do that anymore because gold is now free trading. And so this could happen by a free market stepping in and performing the same actions that the government did almost 90 years ago. The point is some gold is going to be important. Now, there are people saying, what about silver? What about oil? What about bonds? What about the US dollar? That is what we get into in our premium subscription, which is called Precious Metals Intelligence. We cover not only the trajectories for gold, but also silver, also the US dollar. We are preparing to attempt to profit from a decline in the stock market, which we expect to be coming later this summer and into the fall. Guys, you will not see this type of analysis being presented anywhere else. And so I encourage you to investigate the subscription that we offer here. I believe it is going to be invaluable in helping you to navigate these years ahead of us. If you would like to speak one-on-one to me, Christopher Aaron, please know that I do individual voice and email consultations with individuals when your situation requires an independent and researched strategy. I do not take any funds from any of the dealerships or any of the stocks or funds that we profile here in this service. I'm entirely dedicated to helping individuals to navigate this as best as possible. I work with people from across the spectrum, those who are just starting to those that have multi-million-dollar portfolios that they are looking to diversify across the space. Really think about this. Think about those data points that we looked about, that gold to silver ratio breaking out above an all-time in the history of recorded data breakout. All-time high that we are seeing right now. And it's come back a little bit over the last couple of weeks. But when you see an all-time high breakout in that kind of way, that breakout is telling you something. It's a thermometer. It's saying something. The politicians are not going to tell you this. The central bankers are not going to tell you this. Ratios between asset classes have an unemotional language, all their own, if we know how to decipher them. Also, I want to say thank you to those people who are supporting these free videos on Patreon. You can find a link to that below if you would like to support these videos. And preference for future topics on videos goes to people who are supporting this channel. Last but certainly not least, make sure to hit that big red subscribe button and the bell to be notified when future videos like this come out. This is going to be one heck of a wild couple of years ahead of us. I'm glad to have you here. I want to encourage you, as always, to take care of your health foremost, because if that's not solid, then none of this stuff matters. Take care of your health physically, mentally, spiritually, and then let us get these playbooks right.